Hello everyone and welcome to a webinar produced by the Global Foreign Exchange Committee on Cover and Deal. My name is Mark McCarthy and I'm a Policy Director in Financial Markets at AFMA, the Australian Financial Markets Association in Sydney. I'm here with three luminaries of the global foreign exchange market. They are Akira Hoshino, Managing Director and Head of Foreign Exchange at Citi in Tokyo. Akira is also a Vice Chair of the Global Foreign Exchange Committee. Neil Penny, Managing Director and Co-Head of Trading at Refinitiv in London, is also a Vice Chair of the Global Foreign Exchange Committee. And Bob Toll, Managing Director and Global Head of Financial Risk Management at Fifth Third Bank in New York, although he joins us today from Salt Lake City. Bob is also a member of the Foreign Exchange Committee of the New York Federal Reserve. Welcome, everyone. Well, let's get things underway by firstly asking Neil to explain the role of the GFXC and the FX Global Code.
Thanks, Mark. The Global Code of Conduct has its origins in the FX industry's response to the global financial crisis. It's a joint effort between public and private sectors to do three things. First, to define what good conduct means for participants in the FX market globally. Second, to ensure that the industry aligns with these principles of good conduct, to put the scandals of the past firmly in the back mirror. And third, to be future-proof, so that the code remains fresh and relevant as the industry evolves. The code is intended to apply to all market participants, whether they work in large banks, small banks, hedge funds, asset managers, or corporations. Central to the vision of the code is that conduct is a shared responsibility of all market participants. The code itself is voluntary. Firms that choose to adopt the code's principles can signal this by signing and publishing a statement of commitment to the code. As of today, there are close to 1,000 organizations that have already done this. And the number continues to grow as organizations work through the processes of committing to the code and adopting it. The code is maintained by a committee of central banks and private sector market participants from about 20 countries, and this committee is known as the Global FX Committee, or GFXC. The GFXC's purpose is to ensure that the code continues to meet the three goals I mentioned earlier: define what good conduct is, drive industry adoption, and ensure the code evolves with the industry. So how does this connect with today's webinar? Well, the general philosophy of the code is to recognize that the FX market is complex and diverse, and to support as much of this diversity as possible, provided that it doesn't compromise on the importance of good conduct. In other words, the code aims to support existing and new best practices in the FX industry, as long as they're conducted for the benefits of market participants. Unfortunately, some practices in the FX market are tricky. They are an important part of the way the market operates, but they could potentially be operated in a way that is not in the interest of some market participants. So there's a potential conflict of interest here between market flexibility on one hand and good conduct on the other. In these cases, the GFXC's goal is to ensure that the issues are well understood and that market participants are operating with good knowledge and transparency. The purpose of today's webinar is to dig more deeply into one of these areas, known as Cover and Deal.
Great, thank you very much, Neil. So let's get to the topic of today's webinar, as Neil just mentioned, Cover and Deal. Bob, what is Cover and Deal and how is it used in foreign exchange markets?
Cover and Deal is essentially an arrangement where the market participant is looking to handle the client's trade without taking on any market risk. Oftentimes in the electronic markets, banks will quote on a last-look basis. This gives them the final opportunity to accept or reject a trade request on their quoted price. For example, when the client makes a trade request, the bank may want to check that their price is still current, that the market hasn't moved. The small period of time in which the bank performs that check is the last look window. In a cover and deal arrangement, the bank will use the last look window to try to cover their market risk. They will only accept the client trade if they're able to execute the offsetting trade during the window. Dealing in the market before finalizing their trade with their client means the bank has not taken on any market risk. We can step through slides that will illustrate the last look process. You can see on slide 6, the client is requesting a quote from their bank. The bank is then going to simultaneously go out and request a quote from their liquidity provider. The LP will provide a price to the bank. The bank, in turn, will then provide the price back to the client. The client will then make the formal trade request. The bank will then, in turn, make a formal trade request to the liquidity provider. At that point, the LP will accept or reject the trade request. Assuming the trade request is accepted by the LP, the bank bank will accept the price from the LP, provide that price to the client, and that deal will be executed and finalized.
Great. Thank you very much, Bob. That was a great explanation. Now we know what cover and deal is. Akira, what type of market participants use cover and deal and for what reasons?
Cover and deal is often used by smaller or regional banks that don't have the capacity to warehouse market risk. In a liaison with the industry, it is apparent that hundreds of banks worldwide use this sort of workflow to manage their clients' trade requests. For example, regional banks may automate the white labeling of prices from their liquidity providers and be trading on a cover and deal basis. There are many ways in which services may incorporate cover and deal and be provided, such as via single bank platform or multi-bank platform. It is not only the smaller or regional banks that may utilize cover and deal. Certain market center banks that wish to easily provide foreign exchange services may also be trading on a cover and deal basis with their clients. For some banks, it may be the case that as a market maker, they are set up to manage market risk during the trading day in their own region. But at other times, such as through the overnight session, they may use cover and deal model to manage their clients' trade requests. It can also be the case that some banks have the capacity to take on market risk in only some currencies. Nevertheless, for the other, usually minor currencies, they still want to be able to provide prices to their clients and handle any trade requests. But as they don't have the capacity to manage risk in those currencies, they always cover their risk before finalizing the trade with the client. In short, the cover and deal model can be used by any market participant who has little appetite for market risk, but still wants to provide foreign exchange services to their clients.
Great. Thank you, Akira. So, Neil, back to you. What does the GFXC see as potential problems associated with cover and deal?
Thanks, Mark. It's worth starting by emphasizing that cover and deal isn't necessarily a problem. In fact, for many clients and banks and many trades, it is actually the best way for the bank to respond to the client's liquidity needs. As Akira has explained, it enables a smaller bank to offer its clients liquidity from larger banks, and the benefits to the client may include the ability to deal in larger sizes, to access liquidity at all times of day, to trade in minor currencies, and to receive tighter prices than would be the case without this arrangement. However, the client does need to be aware of what is going on because the cover and deal process does introduce some risks for the client. When a client has made a trade request on a quoted price, any trading activity by the bank that utilizes the information from the client's trading request signals to other parts of the market what the client's trading intentions are. This includes the cover part of the cover and deal workflow. These signals could move market prices against the client. If the client's trade request is rejected, then when the client comes back into the market in a second attempt to complete the deal, they will find that the market has moved against them, and they'll receive a worse price than they would have originally been quoted. What is important here is that the client understands that cover and deal is being applied to the dealing process and understands the trade-offs associated with this practice. Most of the time, the client will benefit from deeper liquidity and tighter pricing, but with a risk of information leakage and the possibility of the client receiving a worse price if the first trade request is rejected. Therefore, the process must be handled properly by the cover and deal bank, and there needs to be full transparency with the client that this process is being used and a real understanding by both parties of how the client's trade request will be handled.
Okay, so what is good practice for someone using cover and deal to trade with their clients?
So there are three elements which really constitute good practice for cover and deal that are covered in the Code of Conduct. So the first is there's an explicit understanding that the market participant will fill the client's trade request without itself taking on market risk in connection with the trade request by first entering into offsetting transactions in the market. The second, that any volume traded in the last look window and received by the market participant will be passed on to the client in its entirety. And the third is that this understanding is appropriately documented and disclosed to the client ahead of the trade.
Great. Thanks, Neil. Bob, what would be an example of inappropriate cover and deal trading?
Inappropriate dealing in cover and deal is essentially where the client will make a trade request from the bank. Let's assume it's 50 million euros they want to sell against US dollar. The bank will quote the price to the client. Client will then make a formal request to sell 50 million at the quoted price. The bank makes the trade request to sell 50 million to their liquidity provider. The LP will make the price check, either reject or accept the trade for 50 million. Now, the market begins to slightly move to a lower price. The bank making the price to the client may only fill a piece of that order, let's say 45 million euros. By doing this, they have inappropriately used the cover and deal model. They have not offset the entirety of the risk, and they've taken on market risk, which is not the intent of cover and deal. By not passing on to the client all the volumes of trade during the last look window with its liquidity provider, the bank has taken advantage of the client's trade request, their confidential information, in order to profit from price movements during the last look window. This is a clear example of conduct that needs to be avoided. The client has been disadvantaged, and the full 50 million should have been purchased from the client.
Great, thank you, Bob. Well, Kira, now that we have some idea of inappropriate cover and deal trading, what do clients need to understand about cover and deal?
Yes, I think there are several things which clients must understand, and at the same time, market participants using cover and deal should help their clients to understand. Principle 8 of the code says that market participants should be clear about their roles and capacities when executing transactions. As I mentioned earlier, it could be a feature of a bank operational setup that during particular trading hours, they process clients' trade requests using cover and deal, but at other times, they may be prepared to take on market risks themselves. This should be appropriately disclosed to clients. Clients must also be aware of how their confidential information is being used. Principle 19 of the code provides guidance that confidential information, including information relating to trading activity or positions, is to be used only for specific purpose for which it was given or otherwise agreed with a client. In a cover and deal arrangement, information about a client's trade request will be relayed by the bank to the liquidity provider without any guarantee to the client that their request will be filled. Clients need to be aware that this is happening. Finally, clients should also understand how price changes during the last week window are treated. One of the main reasons why banks quote prices that are subject to a last look is to make sure that their price hasn't become stale in the time it takes for clients to make their trade requests. In a cover and deal arrangement, if the market has moved against the bank, they won't be able to cover their risk at the right price. Because of this slippage, they may reject the client's trade request.
Okay, well, that's fine, but what if the market moves in favour of the bank? What if they are able to cover their risk at an improved price?
The code doesn't provide direct guidance on how price improvements or slippage during the last look window should be treated. That's a commercial matter between the parties. However, Principle 17 of the code stresses the importance of clients having sufficient transparency around their counterparts' execution practice so they can evaluate the handling of their trade requests. So providers should be transparent about their last look practices, including how price changes during the last look window are treated, in order for clients to be able to make an informed decision.
Well, thank you, everyone. We appreciate your attention today. From today's webinar, we hope that you've been able to get a better understanding of how cover and deal trading arrangements are used in the foreign exchange market and what market participants should be aware of. If you'd like any more information, please refer to the report on cover and deal published by the GFXC in February 2019, and of course, look towards the FX Global Code itself. And finally, a big thank you to each of our panelists for their participation today.